talking today to Keith Cullen, who is both the founder and CEO of WT Financial Group, ASX code WTL. It's got a market cap of around 25 million. Keith, WT Financial Group has just become Australia's largest independent advisor network through the acquisition of Synchron. That's moved WT Financial Group to about 600 advisors and 18 billion under advice. That's a big number. Where are the synergies and efficiencies when acquiring a new dealer group?
Tim, I think the most important thing is to state is that as a dealer group, I think you really need scale these days. The complexities in delivering advice and servicing and supporting an advisor network, with given the way the industry's evolved from a regulatory perspective and education standard perspective and the complexities of advice perspective over the last few years, scale is really important to be able to underwrite the right level of intellectual property and personnel within a business to give advisors access to all that they need access to. So probably the key efficiency is just simply the delivery of scale and being able to underwrite the right level of infrastructure. But of course, you know, on the back end where you're processing payments to and from advisors, where you're running training, ongoing professional development programs for advisors and the like, is you do pick up a lot of efficiencies out of that by bringing, you know, businesses like these together.
Keith, it's a significant acquisition. How has this changed the financial outlook moving forward?
Yeah, considerably, Tim. I think, look, it's a game changer for us. As last year we completed the acquisition of Sentry, and having done that is that sort of signalled really the final stage of our evolution or transition to being a predominantly B2B business servicing advisors rather than providing services direct to consumers ourselves. Associated with that, we had a lot of balance sheet write-downs, and so we reported a pretty significant loss last year after tax of nearly $4 million. We completed the Sentry acquisition and we said, look, we see a strong return to profitability for this financial year that we're in now. And we said we'd do revenue of around $70 million and an EBITDA for the year of about 3.5, and that we expected to deliver a net profit after tax of better than 2. Well, we've just had our half year result. I think you and I spoke about those the other week, and we're bang on all of the metrics for that, at or above all of the metrics. So we did 35 million for the half year, and an EBIT line of or an EBITDA line of 1.65, and a net profit after tax of just over 1.1 million. So we were really pleased with that. This is next level now for us, as we've provided guidance to the market today for next financial year, indicating we expect our gross revenue to be 170 million or more, the GP to be 8 million or more, an EBIT line in excess of 5 million, and a net profit after tax in excess of 4 million. So, you know, look, that's doubling again. And I think by any measure, when you line us up against our peers, as the stock's really undervalued where it's trading at the moment. Is
there any plan to return capital to shareholders by way of dividend in the future?
Look, you know, board and management owns about 30% of this company. So we're certainly aligned in our thinking with shareholders. And so when the opportunity presents us, we'd love to get back to dividends. The company had a strong dividend history in our first few years, paying out more than $7 million in dividends. We were profitable when we listed on the ASX. We listed under the profits test. So those few years of the rocky road of transitioning out of the B2C space that sent us into negative territory were not comfortable territory for us. So we're happy to be back on the right plane, and as and when opportunity presents us, I think we've maintained our dividend policy, which is the directors say that as and when it's appropriate with profits, as we intend to pay dividends twice yearly. So it's a path we're well on the way towards being back on.
Your Synchron acquisition, Keith, is on top of your most recent Sentry Group acquisition done sometime last year. So you moved quickly from kind of 42 advisors to 600. Is there any problems with integration? I mean, we know a lot of these individual advisors work on different platforms with different software providers. Is there any lessons you've learned from the Sentry acquisition?
The fortunate part is that, Tim, there's really good product providers or solution providers in the marketplace that tend to dominate the marketplace. As you've got Xplan, Advisor Logic, and you've got Midwinter. And so now that we've got that sort of scale in the business, we're able to have the people within our business that understand each of those different types of systems to support them. And it also puts us in a position where we can be influential with those technology providers to put pressure on them to apply the right developments that give us the right dealer group oversight. A lot of these tech providers have really focused on delivering well at a practice level and not really delivered as well as we might like to see them do so at a dealer group level to enable us to support lots of advisors like that. So there's always issues with tech. I spent more than a decade running a listed tech company, really at the bleeding edge of the internet. So very familiar with what the challenges can be. But unlike being at the bleeding edge like we were, this is a very mature market from a tech perspective. So again, if you're a smaller dealer group, you probably need to mandate just one particular platform for your advisors to choose, because otherwise you find it hard to support it yourself. But when we've got this scale that we've got now, it's easier to be agnostic about that tech.
Keith, demand for financial advice continues to grow, but the number of advisors is declining. But advisors can also only service a certain amount of clients. Is financial advice a low margin business in that regard?
Well, it can be if advisors don't structure their proposition properly and don't have confidence in what they're doing, and they don't select, their clients well. And so it's really one of the key aspects of what we do as a dealer group, is we work with our advisors to make sure that they're pricing themselves accordingly and that they're really maximising their return on their own investment, which is their time. At the end of the day, these are professional services businesses, and it's really imperative that they're appropriately pricing their time. So it needn't be a low margin business, and most of the advisors in our network have got their head around that these days, and we continue to work with them. But it can be if you're not careful. The key thing is, Tim, that advice is getting more expensive to support from a dealer group perspective, which puts pressures on the advisors to push their fees up to their clients. Now, the fortunate part for ourselves as a dealer group and for the individual advisors, there's a lot of people out there seeking advice. And so, look, we're on the doorstep of the greatest intergenerational wealth transfer in history. We've got about $3.5 trillion that started to pass from one generation to the next. And so the complexities of advice are just growing, and the demand for advice is growing. You've got more people heading into aged care, needing aged care advice than ever before. More people transitioning to retirement and hitting retirement than ever before. You've got more people wanting to look at that intergenerational wealth transfer, so they're, succession planning. And then you've got all of the recipients of that wealth that need investment advice. Now, so there's lots of demand there. The issue is more, I think, for government and our industry as a whole to grapple with making sure that we don't leave people that are becoming, if you like, lower value clients behind. And I know a lot's been said about fintech opportunities over the last few years, and you and I have talked about them a lot before. I think the key is, though, to really deliver on fintech. Dealer groups like ours need to come up with ways of allowing those fintech solutions to be delivered through that sort of community-based advisor living in the local area, so that we're giving advisors the tool to really deliver stuff at a more affordable price for those people. The whole notion of just having self-guided investors on the internet, I don't think it works for those younger people getting into the advice space, or for, if you like, the lower value clients that really desperately need advice on things like transition to aged care and how they're going to fund their retirement.
I think we spoke about this recently. It's almost back to the future for the advice industry, given we've kind of moved away from the major banks effectively owning the industry, and to now the growth of major independents like W2 Financial Group. What do you think the future looks like?
Oh, look, I think it's really bright, Tim. I think it all comes back to that demand for advice that we just talked about a moment ago. But it is back to the future. Look, the dealer groups in this country or advice networks in this country all really got built. The really good ones all really got built by privately owned hands, where the people that owned the dealer groups and that ran the dealer groups had been advisors themselves. They understood what it meant to sit in front of a client. They understood what it meant to try and grow a practice and make a practice profitable. And so they added real value to the advisors that were in their network. Of course, then what happened is the rest is history. As the banks came along, the insurers came along, they saw the opportunity to use these groups as sales distribution, really. And we got this whole vertically integrated model that dominated the space, led to a whole bunch of regulatory change to deal with the conflicts associated with that, which in turn led to the Royal Commission. And the banks have all abandoned the space. We've got IOOF and AMP left, with that vertically integrated model. And most of the rest of us, it is back to the future of the operators running the businesses, knowing what it's like to be in a practice and knowing what it's like to sit in a room with a client. And so at both a dealer group level and for clients and the market generally, I think the future's looking really bright for us to get back to the future.
Keith, always good to talk to you. Congratulations on the transaction.
Yeah, thanks, Tim. I really appreciate the opportunity.